So basically, we're gonna stepping through a acquisition of our Oak Tree apartment, which is 76 unit apartment in Phoenix that we bought in last year, and operating right now and stabilized in a year. So wanted to kind of go through. So I think everybody is interested. You know, there's all these high level concepts, etc. So I want to show you like how we actually do this, right? And then what are the stuff that we are actually looking for when we acquire property. And like I said before, unlike yesterday's session, I'm going to pack in a little bit more information on how we're operating this too. So getting to kind of the details of how we're doing apartment buildings. Cool. So who am I? Why am I talking over here, right? So I started investing in real estate since 2009. And I updated slides over here. I did a little bit calculation over here. I own 172 units. We got another 50, 60 under contract, two more property under contract in Arizona. So that number is probably going to jump to 230 around there. So I'm also a principal owner on about over 1,000 units in Texas and Arizona combined altogether. I think we're approaching 1,500 or so right now. I also invested, in addition to that, 1,500 units or so. I lost my condo over there passively myself to other people's syndication projects as well. So I get involved in real estate. Multifamily is a area where I double down because that's the area really I'm focused on. So, you know, I invested passively. I invest as syndicator. I own my own properties and I do 1031 exchange. So pretty much all the whole shebang was multifamily. I focus on B and C class properties with value add strategy. What does value add means? It's, you guys went to a lot of session yesterday about BRRRRs, right? So essentially it's doing this in a larger scale. We started with fourplex. We actually started with single family in 2009 and then kind of following the similar strategy moving forward. I've always been a buy and hold investor. So don't ask me any flip questions. I do not know what they are because I've actually personally have never flipped, and you know I might people who actually does that because it's very labor intensive. So I've done, like I mentioned before, I've done multiple 1031s. Until this day, I still have things that I will screw up. So I use wonderful Bill Exeter as my 1031 exchange person. And we've done 1031 from one property to one property the traditional way, one property to multiple properties. And we have also done a tenant in common structure, which we own a fraction of a property where we 1031 into. So multiple different ways. And then also exchange out of that tenant in common into a whole property as well. We've performed the multiple BRRRRs. These larger properties are kind of in sense of BRRRRs. BRRRRs obviously is a term that coined by Brendan Turner, but essentially it's just good old fashioned value add. We start doing that before the name was coined even. And then I'm also recently a venture I'm being on is being an Easy FI University. I founded Easy FI University. We're under a beta program right now. Basically, it's a program I teach people how to retire in 10 years or less, like I did, because I quit my job last year. And so here are some projects that we have. So like we're real. These are projects, you can look them up. So these are the projects that we own in Phoenix MSA. We actually have two more coming that we have under contract, fully raised and, you know, ready to go. One of them I'm actually 1031 exchanging from this 36 unit into. And then here are our projects in Dallas. So we're also partnered in Dallas with one set of operators over there on all the projects, etc. So there we have over 1,000 units and we're vertically managed. Vertically managed means that we own our own property management company. So that this way, in this special title, we'll talk about that later, it gives you a little bit of more extra edge. So if you own small properties, you realize that if you self-manage them, which is how we did when we first started, while having a W-2 jobs, I was self-managing these fourplexes. It takes extra time, but you know your margin is a little bit higher as well. It's a special market right now because everything's so expensive. So we're looking for a different competitive edge to be able to like purchase a deal and run it very well. Okay. So, cool. So the first thing that I want to kind of talk about, when we first start acquiring this property, like any property, really any market, we actually try to pick a market before we even think about the property, right? So at that time, Phoenix is a relatively new market for us. We already established in Dallas. But going into each market takes a lot of time. So for a lot of you folks, like thinking about acquiring new property, the first challenge is picking a market. Like, how do you pick a market? And here are some standards that we have. And then we should probably adjust them a little bit as well because the COVID environment. So this year's market is very different than last year's market. Keep in mind, we purchased this property in the height of last market, so like last year's market. So it's a little bit different standard. But want to share some of the stuff that I use to pick a market that I desire. So what I look for is I look at above average rent growth and the population growth. This is like the most important thing for me. I know for some folks that they love to invest with cash flow because like on the medias and etc., you guys hear about, oh, invest in apartment buildings so you get cash flow. That is true, but cash flow never make anyone rich. It helps you quit your job, but cash flow does not make you rich. It's not a exponential increase. Now, a lot of you folks do single family or smaller property. You understand the magic of equity is where it's going to help you create wealth. So any vehicle that you kind of invest in, or at least that's my philosophy, I like to kind of see a little bit of both, right? So this way you kind of doing a little bit more cash flow to make sure that you can hold on to the property, and especially this downturn. And then also when you come out of downturn, you're able to kind of multiply on your equity. So which is why I always believed in investing in tier 2 markets. And people will say, what, Dallas is not tier 2? They're like primary market. It's like actually Dallas by a CoStar report is a secondary market, same with Phoenix, but they're pretty big metro. And tertiary markets are like markets that potentially have a flatter growth rate. I've personally never invested in tertiary market. It could work if your goal is, if you're at a different stage of your growth and you want to kind of just preserve cash and then like having cash flow to kind of live off with, then the tertiary markets, quadrilogy markets are great for that. And so I like secondary market, therefore I always look at rent growth and population growth. Now, why is these very important is because when you have population growth, you're going to have a shortage of supply of place for people to live, hence creates rent growth. So rent growth is really the primary stuff that I'm looking for. And rent growth particularly is very important in value add because then you can increase the rent, which then apply this multiplier called cap rate, then you increase the valuation of your property a lot more. So unlike a single family, multifamily is evaluated on the formula. It's essentially running a business, and how well you do with your net operation income is how much that valuation increases. So that's why it's important for me. That's a single thing that is very important for me for the markets. How do you find these information? You can find apartmentlist.com. You can find, I think there was a wonderful track in the conference, Rick, I think, from Real Track that was showing all these data. I was just kind of soaking that up because all these data kind of help you determine which markets to pick. Now, if you want to kind of think about, have some slides later on a few markets, if you just like, tell me which market looks good, right? So I have a few markets later, we'll talk about that. Okay, so we want above B minus location with clean assets. Clean is a quotation mark because the dirtier they are, the more value add there are. Ideally, if you get a right price, you can kind of like make more profit. So that's a loose definition over there. But the B minus location is a hard criteria for us because in the past, we have done some properties in the C minus location or like kind of the lower income location, and they have been a lot of trouble and there's a lot of repairs and etc. involved. So we've learned in our past, it take a lot of work to get them to perform. So we learned from past experience that we want to kind of stay at more like a B minus location. How do I determine that? I look at median household income which is a great stats. You can kind of look it up even on Google, just type it in, like this zip code, what is the median income, right? And so you're able to kind of see that the standard in Texas and Phoenix, this property is in Phoenix, is above like $45,000 is kind of where we're looking at. Again, if you live on the West Coast, you're pretty shocked, like you're like that low, but you know, keep in mind the standards of living is a little lower in the Midwest and Southwest market. And then other things that we look for syndication, even for our own project, we try to underwrite it. Underwriting is just a fancy word saying analyze of your deal, see what the returns are, projection. So we try to underwrite it that in 5 years, we're going to be able to achieve a 70% return and above 7% cash on cash return for holding 5 to 7 years. So that the time is the biggest and non-predictable fact. As long as your property cash flow, then you're just kind of working with the time. The quicker you exit, the more profit that you're going to be able to create, right? Because the time is definitely part of the formula over here. And that's actually a concept I learned when I get into syndication from self-owning. Time is money, literally, right? Because if I can turn around the projects in 2 years and then get into another projects, then I almost double the profit, right? In 5 years compared to if I hold on to a property for 5 years. But given the current markets, I would say you should be expecting to hold 5 to 7 years of holding. If you can get out early, then good for you, luck for you. But I never underwrite it. That's the case. Okay, long-term fixed loan. We wanted to get a long-term fixed loan, which is the reason why I'm not in mobile home park yet, because getting a loan out in mobile home parks is very difficult. I often uses agency loan, what they call agency loan, non-recourse long-term fixed loan. Non-recourse means that should the property, we lose the property, or if it's not performing, we lose the property. You know, you do lose investment money, but it does not go after you personally. So that is important factor when we're investing in these larger apartment buildings, because we don't want any liability for investors and etc. as well. For syndication, this is a loose criteria. We usually looking for over 100 unit for syndication, but actually in Phoenix, we have found success in doing smaller property because it's such a growth market. So we're going to be able to get in and out a lot quicker. And hence, smaller they are, if we do value add, it takes shorter time to do it. So we're going to be in and out really quick. Versus the large unit, 100, we have 200 units in our portfolio too. They're just like turning a Titanic. It's like really slow, right? And then so for Dallas, we love these larger apartment, like really large ones, 150 units or above, because it's a little bit more mature market with less rent growth. So then we're able to kind of do a yield play per se, and then creating cash flow as a main purpose, and holding on to them 5 to 7 years for a longer holding period. Whereas in Phoenix, I recognize like this kind of like a niche area where we were able to find a really good property management on a small apartment, which is the key on small apartments. And I have experience operating small apartments, and that's important. And sometimes it's harder than the larger one because, you know, your PM is not as professional. Things are a little scrappy, right? But I'm able to kind of jump in and then do like a lease up and do this and that because I had some experience doing that. And so we have carved out a niche for ourselves to be invested in actually smaller than 100 units or less, even going down to like 27, anywhere between like, 12, like 10 to 50 is kind of what they consider no man's land. The reason why we're going after these is because it's such a growth market in Phoenix. So we're able to turn these around really quickly with value add strategy and then be able to kind of sell it to a much bigger buyer pool. So less sophisticated buyer pool, right? Because once you get into the 200 unit or 100 in Phoenix, it costs more. Then you're kind of working with a little bit more sophisticated investor that's like really hard on the numbers. So your buyer pool is a little bit more limited. And then we look for around 150K per unit cost, although the price kind of keeps on going up. In 2019, that's what our criteria is. Phoenix has to just explode and explode and explode more. So this year, that's no longer the criteria because Now that 150K per unit cost has moved to 180K per unit cost, because just the economy and then the trading in Phoenix has been really hot lately. And we try to look for a cap rate over 5, but that's not a hard requirement. This property was actually under 5. The reason why that is because every single unit, the property got, um, basically the property was bought and held by the by the seller for 17 good years. So there's a lot of built-in rent growth that he has not realized, about $200 per unit also, which we realized without even doing any updates when we took it over. So that's important. So that will make the cap rate a lot more compressed, but still a lot more profit for us to have. So this one is a loose one. Broker's gonna always ask you what cap to look for. You want to kind of understand what the market cap rate is. You want to be around the market cap rate. Not much too much below, but if it is below, there's a good reason why it's below, right? And then the last one become more important during this market. It's the affordability gap, which everybody know the interest rate is really, really low. So buying single family home become a viable alternative, especially if you're targeting like a location where your tenants are really good credits and etc. Then you're competing with these owner moving out, and there's this de-urbanization that's happening, like people moving out to outside location where they can afford a mortgage that's only 100 or 200 bucks more than the rents, right? So then they will do that. And then so we have seen our portfolio in a location property, we have a little bit loss of attrition there because people have money to buy property and the interest rate is so low, they are taking advantage of that. So you want that gap to be pretty big. It's a difference between paying the mortgage and paying the rent, because then in this case the gap is a lot higher for them to go try to own a home in the near surrounding area. Cool. So we picked the market then, and we're like, okay, this needs to be somewhere above B- location, and this property has just made the bar. It's about mid Phoenix area. And also, if you are thinking about investing in the market, definitely like fly out there. Fly out there, do the drives and all that stuff, and that's what we did. And it turns out Phoenix is a very tricky market. Blocks to blocks has a very big discrepancies in terms of, even though the zip code is saying median income is this amount, but when you can kind of actually drive the block, you notice like actually right beside this block, there's a block that's really bad. You don't want to be in that block. Instead, you want to be in here. So that is nothing can be replaceable. You can't do internet research on that. You just have to know the market very well by driving it, asking the local people and etc. So that's the second step when you're kind of diving into a market, which is always good to do a lot of research of your market and lock it down. In Dallas, we can literally use CoStar report and try to lock down the block because blocks are so spread out in Dallas. And also, it's a little less disparity. It's basically, okay, this is the submarket and this zip code is pretty even, right? Like there may be a disparity on north to south, like north is a little higher, south is a little lower, but in general, it's a little easier to predict in Dallas. Cool. So at the time when we purchased this was 2019, and then we kind of looking at a multifamily forecast. This slides will be replaced for new acquisitions because we're doing kind of case study on this property with the future slides of 2020. So I always try to log in, like, the brokers had these reports every quarter. So I look up like Collier reports, I look up Northmark reports on that local market, just to see like what all the forecasts and etc. are. You can always pull US Census as well for that information. And this slides is taken from Berkadia. So, again, another thing, Moody's analysis on employee growth. So these are some good areas to kind of find some data. Cool. So at the time when we looked at this growth, and this actually didn't change too much. The New York changed a lot, but aside from New York, this didn't really change much. In fact, the Phoenix has increased a lot more, and it becomes like the number one employment growth in the whole nation right now. So as you can see, Phoenix market is very favorable. Atlanta, I've heard someone who is from Atlanta as well. That's also a very favorable market. The South Carolina, North Carolinas are really great too. Houston, Dallas is continue to be kind of the darling of the nations too. But Phoenix has exceeded in the last year to this year. They've swapped position even just in the last quarter with Seattle to be like the top growth in the employment rate, as well as the inbounding population rate. So that's great. You know, that's what you want to see for multifamily investing. And here again, rent growth over here. Phoenix was behind Las Vegas and Orlando, but now in 2020 Q2 report, they have exceeded pretty much everyone. The year-to-date rent growth is still 5.4%, which is compared to last year, which is phenomenal because most of the nation are in the negatives right now. And then if you're anyone who's predicting more than 2% rent growth in current market is a little crazy. You know, even Dallas, it's around that. It's less than 2%, depends on the sub-markets. But Phoenix has like year to date still continually hold solid. So it's phenomenal at 5.4% rate. Think about it, right? When we bought this property, why is it $200 in the market? It's easily justifiable. If someone tell me in Dallas, like this property is $200 in the market, I'm like, are you sure, right? But in Phoenix, it's totally reasonable because the year-to-date rent growth in the past 3 years has been over, you know, the past 2 years has been over like 8% every year. Now this year has slowed down a little bit, as you can see, still almost 6%, right? Which is pretty ridiculous. And then the normal growth is typically about 2% is a really good growth market. So 6% is just phenomenal. And for some of your folks who are in Seattle area, you have experienced it over this in the 2017, 2016 time, where every year we're increasing in a double-digit manner, like a 10%. And this is the market where you can kind of go in and really perform the value add strategy and then kind of exit and then be able to kind of make a quick profit or do the burst strategy. Cool. So that's why we selected the Phoenix, and here's some other stats on Phoenix. We do a lot of market research, but the point over here is if you were to do it, you should also look into a lot of market research. Now, if you want to passive invest in some deals, also validate what the syndicator is trying to tell you, right? By doing some of your own research, you know, of that market as well. Always trust and verify. So, you know, Phoenix, again, what does a Phoenix look like now? This is actually a report I pulled for one of our recently syndicator to kind of just show you guys a little bit about how Phoenix is doing right now. It is the fastest rent growth, you know, and even the year to date right now, it's 5.4%. And the Phoenix has the lowest unemployment rate. That's very important. You want to find a market that's somewhat recession proof. There's nothing that's recession proof, but you want to find like the top dog, right? And then there's no one above Phoenix in this because they have the kind of the lowest unemployment rate right now at 8.3%. You know, it's crazy. Just a couple months ago, you know, that unemployment rate is sub fours. But now like the whole nation has jumped to, a lot of them has jumped to double digits. And then it's a landlord friendly state. I talked about it in yesterday's section too. We're actually getting checks handed to us by the government because they're actually providing landlord relief program to catch up all the tenants, including the ones that moved out organically because they couldn't pay. Basically, they wrote us a check. There's a program going. We haven't received the money yet, but they have already approved our grant. Basically, we were able to apply for these grants and then basically use the money for whatever the tenant didn't pay. So nowhere else, well, I'm only in selected like 3 market, Washington, you know, Dallas and Phoenix. So in Dallas, they didn't have this policy. It was most of the program helps the tenants. In Phoenix, in addition to that, like Arizona government is also helping the landlord. So that is a good message on we are landlord friendly and we think about economy, how that kind of works, right? So you want to be investing in these kind of markets. How is Phoenix MSA doing in the COVID? This is just kind of take a look at it. Obviously, it didn't really matter to us last year. We never know this would happen. But I just want to include a few of these slides over here. Again, vacancies of 5.7, pretty healthy actually. It only increased 0.1%. 10% base point means 0.1%, right? So not a lot. And then asking rent, this is a different report than Collier. Collier actually said it was 5.4. You know, Norris Mark says 4%. It's still like really good asking rent. the effective rent is different because that includes renewals and all that stuff too. So that's probably where the tag on extra 1% is. And then median sales price is about 166K a door, right? So that's why that 150K a door doesn't work anymore. It worked the last year. It didn't work anymore in Phoenix market here. The median is here, and that's important for you to kind of gauge. Are you above the market? You're buying above the market? Could you make things work? And then rent cap is 5%. So we're still on there. And then how many construction under, right? So not a lot of units and fewer even later. So that's absorption rate. You also want to see that. So we'll have a slides later to talk about that. Cool. So then this is a quarterly market report. I took it out. These are all top 6 market in the nation for rental, multifamily investing: Salt Lake City, Austin, San Antonio. Like, see, there's the Texas, four markets all in Texas. So Texas is really great. But then there's also the Phoenix, what they call the Sun Belt area. It's fantastic over there too. So as you can kind of see, the stuff that I kind of highlighted, population growth. Austin is really kind of the number 2. Like, it's basically in the news. People talk about a lot of growth in Austin area, so that's why I kind of look at these two and compare the two. Like, all the other markets still stellar. We're still invested in Dallas. We still love it. But as you can see in this report, Phoenix is actually one of the top market, and you want to be in these type of growth market. So a couple things: 2.6% growth population. Austin is a little bit higher, but Austin is also much smaller metro. It's like more than half the size of Phoenix, right? So like, then your swing of population growth is a little bit more. It means less. And the unemployment rate, everybody else is almost a double digit. And the Phoenix is clearly the lowest on these top markets over here. And again, this is a report on Midwest and Southwest. So there's a whole different report on Southeast. If you're in the East Coast, you should look into that. Florida, Orlando is still very looking good. The Carolinas are doing very good. So you should pull a different report on these things. And all these reports are usually free. So just like search for it, right? And then the average median home income has increased too. So that matters because that plays into, rent growth. And again, they're head to head number 1 compared to Austin. More data, like how many absorption rate, lowest in the market. Absorption rate means if there's no more new units gets delivered in the market, how long does it take? This absorption rate, single family will be about how long does it take for you to sell all the stuff in the inventory in the market. This means how long would it for you to lease all the units that's in the market. The shorter it is, the healthier it is. So this is a great rate when you're kind of looking at this. Again, these are top 6 market. So even though, maybe Dallas is last one on here, it's still very, very healthy. And an average occupancy rate, it's kind of highest in the nation as well. Cool. And also the change since, 12 months change, it's only 0.1%, right? Like, it's kind of like it didn't get affected by most of the stuff over here. And then lastly, it's the medium income household. Like, that kind of determines. But these are like a market specific. So when you're buying a property, you really need to look at the sub-markets. Cool. So you select a market. This is where you want to go. After you sample a couple markets and you go in and you're buying a property. Before you buy a property, you got to assemble a team. And it's team sports in multifamily. Don't think that you can run the property by yourself. Even though you think you're running it by yourself, you're still assembling a team. So you're assembling a legal professional team, but if you're buying slightly larger apartment, you want someone to kind of trade off with you. It can be a husband-wife combo, it's still another person, or you need to find partners, right? And then I'll show later on, like, there's different roles for partners to play. And there's local teams that you need to find for, and which is the reason why you're also flying there, you're interviewing, you're touring the property, and you fill out which people you're going to add into your local team. So brokers, obviously, who gives us a deal, 100% our deals sourced from local brokers. Wholesalers, I didn't have a lot of success with that, but everybody has different ways to do it. Tax protesters, that's applicable to Texas. If Texas tax is really high, Phoenix doesn't really matter. So we protest the tax, right? And then we want to make sure we don't post or social media post on the purchase price of a deal that we just closed. One of my partner has done this before, and we're like, no, you need to take this down right away, right? So basically, it's a non-disclosure state. So the reason why it's non-disclosure is the purchase price determines how your tax is going to be. Because the tax is so high, we want to send these tax protesters to basically argue the valuation of the property is actually much lower. So we don't want to show them a purchase price, and that's non-disclosure. So don't ask your syndicators or anyone like, what is your purchase price? I mean, you should know if you invest into them, but don't social media, like don't post it what the purchase price is if the property is in Texas. Okay, so title escrow, some are national, some are local. We actually tried to do a deal in Mississippi, and it turns out in Mississippi they don't have title escrow. There's only a few states in the nation that does not have title escrow company in there, so you have to leverage real estate attorneys to close your transactions, right? And then property manager and lenders. So the lenders are local. It's a good time to build out about 3-4 lender options over there, just in case if the national agency loan does not work. And then for some of you guys are working on a smaller apartment building, then these are the lenders that you want, like a local credit union, that is very local specific. So in Seattle, we have credit unions that we work with. Phoenix, we're building out a list of lenders. So far, we didn't have to reach out to them. Actually, that's not true. The new deal that we're doing was a hard money lending deal. So that's a local connection that we had too. Okay, so national team, these are people that you can kind of use. I always love national team. If I could do national team, that means that I don't have to do that extra step in my process when I'm running a business, right? I can use the same people. But as you can see, some people are not, you cannot use them. You have to use the local team. So national team, I put mentor over there. They're not really part of the team, but mentor is huge. Like you guys saw some sessions on like why you should have mentors and etc. Like that's huge. Like that's a person that helps you accelerate and cut off the years, right? So my personal experience was, for the first 6-7 years, I wasn't seeking mentor, maybe like on the lower level. Like I was asking people advice. That's like 2 to 4 months of mentor, the free. And then in the last like 3 or 4 years, when I really accelerated is when I decided I'm going to spend a lot of money investing myself on education. I spend averagely 30 to 100K a year. It's a little ridiculous, people think, on educations and etc. And that helped me in terms of growth, 10x, right? So that's very important. I put it up there. And then CPAs, tax strategist, bookkeeper, insurance broker, like all these guys, you need them. You need to file taxes. You don't want to file your own taxes when you get to that level. Like don't save the money. You want to have a good tax strategist to help you using depreciation and all that tax planning to offset your tax. So one thing I shared in the women's forum was that I was paying 0 tax in 2019, right? And then in fact, because CARES Act, I'm actually getting money back from IRS for since 2014, my active income from my W-2. So anyway, so that's a huge, because a dollar in your pocket, how much you keep really matters. You have insurance broker, usually can do multiple states. Lenders, this is the national level agency lenders, appraisers, and security lawyers. Security lawyers are needed when you're doing a syndication. So I see posts on, hey, let's do JV, or I'm looking for an investor. They better be doing 506C offerings, what we talk about. You want to make sure all your offering is legit. You don't want to destroy your offering because you advertise to somewhere that you shouldn't be. So we assembled a team on this particular property with a lot of these connections from national team. We carried them over from our Dallas acquisitions, and some of these local teams we have to build when we're there. And then it took us about, we had a partner that was foot on the ground. So it took him like a year to kind of assemble all these teams and etc. Cool. So then partner, like I talked about my partner. In this deal, I had 2 partners who lives in Phoenix. And that's usually our strategy when we first go into a new market, because you want someone foot on the ground or someone who owns property over there already. Right, so they don't have to be foot on the ground. If they already have a lot of deals in the area, then you kind of know that, and then that's where we are now in Phoenix. And so we feel comfortable going to Phoenix and acquire property from Seattle. I still fly there. It's a very quick flight. That's why I love Phoenix. And then I'm able to kind of do that stuff. So here are some roles in your acquisition. actually not just acquisition, but also like executing of apartment deals. So you need to find someone who can find a deal. Like the characteristic of each of us are built differently. So I'm really good at individual connection with people. So I love working with capital side of stuff and deal structuring, right? So I'm also very data driven. And so I'm seeking for partners when I'm getting into a new area. So someone who has local connection or there, maybe I can coach them to find deal, to have, you know, deal scripts and all that sort of stuff. And someone who's like really organized in terms of operation, right? So like then, you know, also carry on into operation after you acquire the deal, you got to operate it. So I can kind of leverage their resources to kind of do that. So these are different roles in acquisition and running a multifamily. So for you guys who are assembling a team, you should kind of think about, okay, who do I know that kind of compensates my weaknesses, right? So you don't want two people that are the same. That partnership is going to create a lot more friction in the future. And then there's stuff that both of you guys are not good at. Nobody's going to take care of that. So you want to make sure you're finding the opposite attract scenario over here. So finding deals is basically you need to be able to select the market, someone who's over there, you know, be able to drive the property, be able to drive the comps and etc. So deal sourcing is what that is. And then underwriting is kind of part of finding the deal, part of raising the money. So it's the deal structure. That's where the partners kind of come together and underwrite the stuff together, which is to analyze the deal together. So you need to figure out like someone who's experienced, creative to come up with a deal structure with a business plan. You know, I'm more experienced now, so I can look at you know, people present me deal all the time for passive investing or for helping them and etc. So I see a lot of deals, and oftentimes sometimes they will have this like very high value add, even though it's $200 per unit under the market. For this particular deal, you know, we still have to budget in of a more trajectory on getting there, right? Because immediately if you turn this, a lot of newbie mistakes is like, oh, we can just do this first year. On a smaller property, maybe you can do it, but you better be budgeting a huge amount of economic vacancy, because you have to like move the tenants out before you move them back in, because the current tenant's not going to be able to afford these prices. So underwriting comes with experience, and then both you guys who underwrite a deal, like the investor side of thing, the deal side of thing, like you get together to do that. Raising money, of course, that part is you only need it if you're syndicating. If you just have your own money, you already have money to raise, or you're looking for JV, you just got to have a couple of people. The money is already spoken for. We're in the situation right now where we have more money than like there's deals to find, right? So this part is a little easier, but for people who first started, this is actually really hard. So you got to create like the whole funnel of marketing and all that stuff and getting to the raise money part. And the people who is suitable for this is people who likes to connect with other people, who really cares about the customers, the investors, the returns, right? That's the type of person that's like really suitable for that. And then you're getting into the operation. So operation, you can both cooperate on this. So you have different perspective, but on operations, I would say limit your partner down to 2 to 3 only, including yourself, because more than 3 people, it gets into kind of like a nightmare with coordination, right? So oftentimes when you see syndication offers and etc., there's multiple people in the GP. There should be only like 2 or 3 people actually running the deal, because then it gets a little bit inefficiency. And then there's the experienced people all across the board. I think there's a session yesterday, someone talked about like, how do you get into like mobile home parks and etc. You need that experienced person, right? So give out a little of your equity in the beginning to kind of bring a deal to the experienced person, because they're so busy. You know, I get a lot of people ask me about like, hey, would you like co-sponsor a deal and etc. I'm like, well, these are some of the criteria up in the front. Like, I can't help you underwrite. Like, I will help you underwrite a deal once you get it to a certain stage. But I have people like always just forward me the broker package. I'm like, we already have them in the funnel. You know, like if you're just forwarding the broker package and there's no work that you have done, like it doesn't really make a really good partnerships over there, right? So, but you want to get someone who's experienced, get them sign on the loan, and also helping you kind of in the coaching manner to go through the whole thing. So especially when you're doing syndication, you don't want to screw up on your first couple deals. So it's valuable to give out a little bit, like a basically some of your equity to make sure that you have some more experience on your team. Cool. So in this case, our deal, because we already experience in Dallas, but it was my partner's first deals into syndication. Like we partnered before this, so when they brought me a deal and they're like, oh, we want to syndicate this deal, but it didn't really work for syndication, but we had our own money, so we did a 1031 exchange with them. So at this point, they have never done a syndication, so I was kind of like more that experienced person to help them get into that. And it happens to be a market that we want to get into, obviously. So it's a win-win situation there. So the third step is know your sub-market. And this is very important, driving the market, have a partner foot on the market over there, foot on the ground over there, or just taking flights out there, really get to see it. Working with different PM companies or tour a lot of properties, that's going to give you some good ideas about your sub-market. And then know your numbers, do a lot of research, right? So even though in Dallas we still buy stuff, we go into data research because it's so vast in Dallas area or in Phoenix area. Like we really get into the details on the blocks and etc. as well, still doing that. So every single deal merits a lot of data research to make sure the due diligence type. Okay, so talk with a lot of third-party people who lives there. If you have friends and family, that's probably a natural market for you to decide on. So that's knowing your sub-market. I know it's a very short slide over here, but there's a lot of pack information over there. And then you start getting ready to source the deal, right? Before you get sourced the deal, here's the list that I use to come up with, if I'm going to a new market, what are the brokers in there? I look on LoopNet just to see who's the players that's there, local directories, CCIM. CCIM are like the certification program for like the cream of pop brokers or real estate professionals. I've taken some CCIM courses on data. I highly recommend, that could be an education source, the 101 to 104 series that the 4 courses that they provide. Gives you a lot of insight in analyzing a deal, etc. at the theory level. But they also have a directory over there, so I can like look up some of these brokers. And CCIM brokers are usually very data driven, so when you talk to them, you need to know the lingo. You kind of like asking about submarkets and etc. They're usually very knowledgeable with these type of data. And then the meetups, try to go find some meetups in the local market that you're trying to invest in. And usually the networking, like even here, networking is very important so that you get to meet some people that you want to meet. And broker websites. So there's some national big market. We are lucky, we're in secondary market. So in secondary market, majority of the major brokers are over there. They have a national brand, but they have local office. So we use the Marcus Millichap, CBRE, Berkadia that you saw the stuff before, Northmark. So these are some brokers that we use, and there's a lot of deals already. I'm just like picking up the phone to call them, right? And then PMs, if you already try to interview the PMs are very much local, so they're in that pocket. So you can always ask them like, who else do you know? Can you introduce me to some broker, right? So these are good sources for brokers. And then you need to develop a cost script. Know your criteria, what you're buying. Like our criterias are like the stuff that we listed before, right? These are our criteria, and then how many units, how much is the purchase price, like, so you having that written down, send it to the broker is very important, but also pick up the phone and call them. Talk the lingo, learn a little bit about the lingo. A good book I was recommending yesterday was David Lindell's Invest in Emerging Markets. That was a really good book. The math don't work anymore. It's a different time that when he wrote it. But there's a lot of lingo involved in there. So like read the book, learn the lingo, and start talking with broker on this. And then also show proof that you have closed deal before, whether it's being a smaller deal before or in the role before. That's the benefits are your experienced team member comes in, where you get the resume of from them, and then you can say, as a team, we own like blah blah blah, how many units, and etc. So that's kind of how the imposter syndrome we call it, but it's a good thing in real estate. It's like, hey, we've done this before. We, not necessarily has to be you yourself. And get to know them. Ask a little bit of a question to get to know how they are, what their tendency, how do they like to be communicated. Some people prefer email, some people prefer phone calls, right? Like just to kind of get to know that and ask them that question. Cool. And then you got to call them all the time, because I've talked with CBRE people too. I was like, hey, like, what's the best way to talk to you, right? And find the big deals. They're like, we're so busy. Just call us every week. And you never know what you're going to luck into, because we have inventory every week, right? So like, that's how we try to establish that relationship with them. Of course, once we're in the contract, did some deals with them, then we move up on their list. But before you do that, this is kind of how you get onto their list. And then, so the fifth step is underwriting. So there's a lot to learn over there too. But what you need is the trailing 12, what we use the lingo, right? We talk about lingo, we just talked about lingo. The T12 means the trailing 12's profit and loss statements. And then the R&R, it's a rent roll. You just tell them, like, I want the most recent rent roll. So we need that to kind of dive in to see a picture together, a story on what's going on with this property. And then we ask a whole bunch of questions. So when we take that, we ask a whole bunch of questions, and then we plug that into our underwriting model. And then underwriting multifamily, if you're buying a 4-plex and 8-plex, then you can kind of just do a quick cap rate calculation and this and that to model it. But for our property, we have our own modeling. We've modified a few sheets as well for our own structures and etc. But as you start, you're like, where do I do it? Like, so don't worry. There's a cheap calculator that Michael Blanc puts out. Search for it. I think it costs like $200-300. You can just like download that sheet and watch his video on like how do you plug in the sheet. The sheet's pretty complex. And then just start plugging a number and try to underwrite a deal. So I would take a LoopNet deal and then plug it into the formula, put some assumption over there, and just to see what you have and start doing some of these practice, right? And again, going back to that experience part, if you have a mentor, you can like give them to say, hey, can you take a second look at my underwriting? Am I doing this right? So this is kind of where you get trainings on. Or if you have a colleague who's experienced in this, again, that mentor, right, is important. And then stress testing. So stress test is something new that we added in like COVID. We always do stress tests, but we do a pretty simple one. It's like, how long will we last if nobody's paying us anything? Like, I think fundamentally our investor want to just know that, right? And that runway better be like a half a year, which is plenty, like more than a lot of syndicator that's out there. We do that test. But also there's a more finessing stress testing. Okay, so if I'm having 15% collection issue, how long am I going to last with this amount of reserve at the third year? Because in the third year, your reserve is going to be less, right? So it's like, how does that going to actually play? What we realize, obviously, is when the market hits you, you could be in any cycle of your deal. You could be last cycle where you're ready to sell. You don't have a lot of reserve. How do you actually mitigate that? So that's why we do a little bit more complex stress testing over there too. Okay. And then this is an example of that. And keep in mind, we bought this property in 2019 August, so it's a very different environment. But stuff I was kind of talking about before, here is the market increases over here, rent increasing year to year. So this is very conservative in Phoenix market, as we shared before. Year-to-year changes, even during the corona, is almost at 6%, but we underwrote at 3.2222, or 3.3323 in this market. And then the economic vacancy is huge for us on this deal, because we know that we can increase the price to that, but it's going to take like 30% economic vacancy. We assume we're going to turn like a third of the tenants. So we model it that way. And then we look at total income. Again, I have a slide later on, just right after this, so what we're going to look at for COVID deals, right? So this is last year, different. We're able to achieve a 10% increase every year income, especially with a deal that is so under rented. And then other things, this is wrongly circled, but I was meant to circle these numbers, the DSCR. That's basically saying DSCR is a debt to income ratio, which basically give you an idea on, hey, like if I was to pay my mortgage, how much multiplier is that? How, like in this case, is very healthy. 1.5 is a really healthy number. That means I can service the debt and still have, like 2 is really good number. Like, and I'm double the mortgage that I can pay. So this is good. And then the cap rate, is it cap rate? We always include a sensitivity cap rate sensitivity graph on this. And that's a lot of syndications use this number very compressed on their exit. We usually like to see about a 1% spread between our entry exit cap and the exit. At 1% is huge in terms of valuation, right? Like sometimes like a millions of dollars. So this is a very important. If you don't know cap rate, like read up on it. How do you calculate cap rate? Essentially means if you buy something in cash, what is the cash flow, like cash on cash return you're going to be getting? That's kind of like a roughly what that explanation is. But that's the multiplier, like any business when you're buying other businesses. That's the multiplier that gets determined and gets applied. Cool. So, like we talk about COVID, just want to show you an example. So notice the difference over here. Now, when we're underwriting a deal, when a deal comes in for my passive investing that I'm interested in, or when we're doing a deal, this number, I don't care what all the other rates, like what the vacancy is and etc. It boils down to this number. How much total income am I going to increase, projecting increase for the next 5 years? So the next 2 years, it better be, first year to be about 2%, second year to be less than 5, like 4, 3%, depends on the market. And then also we try to project everything under 6% moving forward, right? So you got to be very conservative. But I think personally, in third year and fourth year, we're going to get hit by inflation. So that number could be a lot higher. But still, when you're underwriting, you want to be conservative. Cool. So this is the property that we purchased. It's an 80s, classic 80s, very clean, but everything is classic. We love it. So we did interior updates on them. I'll show some pictures later. So you want to come up with a capital budget, right? So what are we doing with that? So we want to do new interior updates, and these are per unit habit. And again, know your market. In Dallas, we're able to do the same stuff for like $4,000 or $5,000 with our own PM company, maybe even a little bit less. But in Phoenix, you're looking at 12 grand to like 20 grand increase. So very expensive labor over there. And sometimes when I see deals that they have $3,000, $5,000 in in Phoenix, then I'm like, well, you better be just adding wash and dryer, that type of stuff in here, right? And the exterior rehabs are stuff that you want to make sure the property kind of looks really nice. So we budget that, and how we came up with this is we work with vendors, we work with PM companies, and we take that information in, and then we do a rent comp. But no need to like kind of get into the details, but as you can kind of see right now, it is 300, almost 300 under the market over here. And that's true, because even during the Corona time, we were able to increase the rent because simply, there's nowhere else they can move to. Even if we increase our rent 5-10%, it's still the cheapest on our market. So we are getting no problem with renewals on this property. And then you want to do due diligence, and that feeds back to underwriting. So when we show up doing the due diligence, we do a unit by unit inspection. And I posted some Facebook, truly, we just recently did a due diligence. So we did an episode on like, hey, look at how we do due diligence. These are stuff that we kind of check over there. So put it on the Facebook over there. So we have a video talking about that. And then lease audits, you want to see all the leaks. Are they legit? What kind of tenants are they, right? Especially during now, you want to check them. Vendor inspections, definitely inspected. So we had everybody showed up, the roofers, the plumbers, the, electricians, and the PM companies, and then walk unit by unit. Is what we did over there. And then I always get a cost segregation estimate ahead of time because I can take the tax benefit, and my investors, some of them, they can. So that report comes in before we even put the offer out there, do any syndication stuff. Okay. And then raising money. The raising money actually starts way before, you create your database, you figure out your funnel, you figure out your marketing. Oftentimes on your first couple of deals, don't worry about the funnel stuff. Just go talk with friends and family. Just be like, here is something that I would like to do. Now, if you did a couple passive deals before, that's a good track record. Don't think that you don't have anything, because then you can show them, this is what I did with passive investment. And these are like how much return I get. These are the people who I work for, and then reach out to your sponsor, be like, can I be of helping raise capital in the future, right? And then start talking with your friends and family, educate them on this type of investment. If you get into a little bit more games later on, the investor database, the funnel, the marketing, that's a whole science by itself. And then partnerships, right? Like find partnerships when you can bring money, or find partnerships when you don't have money, but someone else brings the money. So these are kind of like ways to get the money raised. And then make sure you do it legally, right? So there's a difference between 506B, 506C. 506B allows you to take 35 and then the credit investors, but you cannot publicly advertise them. And then every single person that you include in there must have a relationship, a substantial relationship with you, right? So 506Cs, you can blast it anywhere on the internet. So don't just assume someone who's blasting on internet is doing 506. If you're investing in some deals, making sure your sponsor knows what they're doing. If they're blasting on the internet, ask them, are you using, what kind of offering are you using? Is it regulation A, 506B, 506C, right? If they say 506B, flag, they should not be advertising on that, right? So then that may be not someone you want to invest with, because that offer right there is already not valid, because they, essentially hurt the credibility of that. We often, to be an investor on our list, we often, like, you have to schedule a call with me. I have to know you very well in terms of your financial parts, like what all that stuff. Like, I want to make sure that I have a personal connection with all my investors. That's why I love doing 506Bs. 506Cs, even if we're doing this later, I still want to know every single of my investors, so that because not all investors are created equal. You want to make sure all the investors are playing nicely with each other and not causing headaches for your offering. That's the most important thing, right? And then closing them, like call them, closing them. Don't just sit around. Email doesn't just do it sometimes. You got to close them. You got to follow up. Cool. Closing a deal with a lender, lots of paperwork. Make sure the lender gives you a list of things to do and really stay on top of it, because the lenders are really slow. They only work on your file when you need to, unless you're poking them all the time. So we have weekly meetings set up with a lender in our closing, making sure we run through the to-do list and closing out every single item. We also make sure our lawyer is in touch with their lawyer, and we want to make sure our insurance in touch with their insurance. And these two are usually the holdups, right? So you want to stay on top of it. Like this week, I just called my insurance guy. I'm like, did you get lender information? And then they're like, we haven't heard from them. So I'm like, well, we're closing in 4 weeks, so we still got time, but let me send an email making sure that you guys are connecting already, because I want to close early, right? So that's that with the lenders, and you have to build that relationships. My personal lender, I always use Arbor as my pref, because me and this other guy from Arbor, we know each other way before we even start this larger multifamily journey. So I know he's going to go to the bet for me on interest rate negotiation, etc. So by default, loyalty is very important. I always make sure that I contact him first and then give him a chance to do the business with me before I reach other people. So to me, this business of royalty is very important, that you want to make sure you don't screw up the next person, because it's such a small circle. You never know what's coming back. Cool. So we got an Arbor loan on this, and then now we're doing operations. So we bought the deal, we closed it. And then during the time I also was pregnant with my son, I actually had a birth in between we closing the deal, which is really fun. And that's when your team comes in. I had an assistant that really helped me and closed all the other stuff. So that's very important. So then we're doing the operation. So a year, so I can share some results with you guys. So during the operation, this deal we bought last year is a lot easier. So we were turning tenants. Our seller, every single deal has challenges. So our seller has did us none favor by renewing to everybody. So we couldn't move anyone out when we took it over for about 4 months, right? So we're just sitting there. It's 100% occupied, which is great, but that existing cash flow is not that great. So like we have to wait for 4 months before we execute our business plan. So make sure your seller is not doing you a favor to renew everybody on the spot right there. And then so we started doing our turning the tenant in January, and we really kind of hit it in February, March. We had the kind of the lowest occupancy rate, and our plan was to kind of get it filled back up, because then we did a renovation. It takes about a month to 6 weeks to do the renovation on the units, and then March we were ready to kind of fill the people back up in there. And we all know what happened in March. So we had a corona happen in March, but even then, because the property was so under rented, we were actually able to get the pro forma rents for updated units. But we also adjusted some of our business plan, right? So turn units, you always tweak. You have a lot of communication with your PMs. bonus structure for the employees, make sure they're incentivized correctly, and really stay on top of your books. That's very important. Cool. And then how are we doing? You know, after 10 months of holding, we're distributing 7 to 9% cash on cash return. Total average is 7% on the first year now that at this point. And then the basically the last one we just distributed out was 9.4, with a little bit of an investor returns, because we budget such a big capital expenditure money, which is great during this time because we have a lot of cash reserve, almost $1 million of it. But the downside is we've done pretty much everything that we wanted to do, and we have decided to halt on a lot of updates. So that because the Corona time, we're testing the market with a lot of stuff, and we noticed we didn't need that much stuff. So now we have a big cash that sits around. So we're slowly, cautiously giving it back to the investors a little bit more, because the investors not getting paid from a lot of their other deals, so want to get them some cash, right? And then so we moved to 78% occupancy rate to about 100 now at this point. Every month we'll have some people leave, some people filled in. So it's about a one unit vacant, you know, at the worst time over here. Cool. So again, do your homework up in the front and really buy them correctly, right? I have a video, but because of time, I'm not going to play it anymore over here. Basically a before and after look of the property, but just want to show a sign. This was the sign before, like oak tree before, and then this is our sign right now. So the quality of the stuff that we did, as you can see some pictures before, you know, people always love to see the after and before, but you know, we can send this out later on the stuff. But it's turned from the 80s to a very nice classic looking, you know, Mediterranean resort, very crisp look. So we finished our exterior, we finished the interior, we proved the in-place pro forma. And then for these exit, you want to prove there's still meat on the bone. So that's why we left some of the unit as classic, especially during Corona time. We're a little bit sensitive. We don't want to push the rent or do the renovation and disprove that we couldn't keep that rent. So we changed our strategy to like adding amenity like wash and dryer in units. Because now everybody doesn't want to share laundry facility, right? So we actually put that on the high priority list I'm doing, and we're holding off most of the value add and just doing turn, because that's going to keep our unit very economy units. And also on turns, we realized the classic units were realizing almost to the pro forma rate anyways, right? So why disprove that value add doesn't quite work right now with our market? Like if your classic is going to be able to almost reach your pro forma anyways, right? So that's kind of what we've been doing. And then we focus on cost saving. Cost saving is very much a thing. I go through a line item pretty much every week, look at the books, looking at that. And then we play with the marketing tour, because right now you have to up your marketing budget to lease up the units. We don't have that problem anymore, obviously, because we're kind of occupied pretty well, but you still want to keep that marketing going. You don't want to skimp on it. But on the other hand, we're also looking at marketing channel, which is effective, what is not. Then we drop some service here and there, managing the expenses. And also going vertical, not on this deal, on all my new acquisitions. I'm trying to create a relationship with my PM company in the area. Obviously in Dallas, we're already vertical, which is we manage our own property. So that shaves us about 10% expenses. So you got to focus on reducing expenses instead of just value add in this case. And collection management, you know, really stay on top of the tenants and communicate. PMs, we put different bonus structure in, you know, frequent communication with them. We meet them every week. And then often more than a week, me and the on-site person has text communications. And then we do the lease up. Lease up is very important in multifamily. So you need to have a really good marketing games and making sure you can do virtual lease up now, right? So we're learning some new technologies to help us doing that. And then lots of communication, like frequent communication with your investor, assure them things are going fine. You know, frequent communication with your PMs, making sure they're stay on the ball, and tenant communication indirectly through my PMs to the tenant to let them know what's going on. Here's the government assistant, really kind of jump ahead of the ball. And cash management, obviously not a problem with this property because we had $1 million pretty much sitting on the side, but with some other property, not so much, right? Like you maybe like a little bit years has passed and now you cash a little bit more strapped. So you have to make a trade-off decisions to focus on cash management. right? So for some deals that I passive invest in, I appreciate it that my sponsor has decided to hold off a distribution during this time, because I understand the cash reserve is really important. It breaks the deal, right? If there's not enough cash. So I'd rather them hold my distribution and ride through this low cycle before they distribute it back to me. And stay on top of laws and government helps. So in this case, we heard the rumors about the government help. We jumped on it right away because the funds are limited, and then we got the awards right away, right? So you want to stay on top of it. If you have applied PPP in the beginning of the frenzy, you understand that the font was limited and was out like within the first couple of weeks. So you don't want to be that. So you got to really stay on top of all the local laws, and manage the taxes. Cool. And then now we talk about exit. After a year, we stabilize this, and on the exit, we're not ready to exit yet, but you always want to check where you are with the market. So every year we have the broker comes in and do a valuation. We do a calculation to see if we're going to make it and what the return is going to be, right? So the exit, you got to plan it ahead, like the loan products that you use, how much prepayment penalties that you have, like all that stuff is a planning ahead. And during the operation, you want to make sure your books are really tight. You're doing trade-off with above the line item, below the line item, the operation line items versus CapEx line item. I do that every single month, right? So making sure, should I need it to sell the property tomorrow, everything's ready to go, right? And then consult your CPA, because there are different rules for you and your investor differently. When you're selling a property, and my CPA will give me advice to say, oh, you're selling on year 2.5, you may want to hold on to it for one more year, like for half a year before you unwind the corporation, because the tax is going to drop off at a year 3, right? Something like that. So you want to make sure you talk with your CPA on this, and work with your PMs on exits, because they're going to be showing the property. They're going to do coordination. How well they are behaving is going to determine how well your buyer is going to be able to access the properties, etc. So you want to partner with the right PMs, but also have frequent communication with them. My PM is so great that he actually also worked on like our books, review this with us before sending it to our brokers. So like they take care of a lot of stuff, but with our approval, right? So it's like a check and balance. And then decide on exit strategy. Are you going to sell or are you going to refi? Like, because now the interest rate is so low, it may make sense to do a refi versus selling a project and then give investors some money back. So you're always playing, before you get into a deal, you have to think about multiple exit strategy for your deal. And then you're playing between these options because market changes, interest rate changes. Last year, we would never know. This year, the interest rate will be dropping to near zeros, because last year the interest rate was going up, right? So that's a big lesson that we learned, which is like we project it forward, and if you pick the wrong, like, you then have to be stuck in the property for a little longer than you need to. So that's all the stuff that we kind of look at and negotiate, obviously, with your buyer. Cool. So that's the session, and this is how you can contact me.